Thank you all for being with us today. I'm Dan Brissett. I'm the president of the Environmental and Energy Study Institute. And we have a very special guest with us today. Senator Sheldon Whitehouse represents the great state of Rhode Island in the U.S. Senate. He's the ranking member of the Senate Environment and Public Works Committee, and he serves as a senior member of the Judiciary Committee, the Budget Committee, and the Finance Committee. He is a steadfast advocate for climate change solutions, and it's a pleasure to welcome him to our briefing today. Senator Whitehouse, thank you very, very much for joining us today, and thanks for all your help with the room and the logistics and all of that.
Glad to help. Thank you all. Well, here's where we all are on climate. First, the scientists got it right. Thank you very much, scientists. Even the ones who were paid by Exxon got it right and reported to it, and then the company squelched what their scientists had said. So then the science came to this body and the other one across the way to Congress, and meaningful climate action got killed at the behest of the fossil fuel industry, which was powered up by the Citizens United decision to spend unlimited amounts of money and to spend it often anonymously. So it comes through groups with funny fake names like, Citizens for Peace and Puppies and Prosperity or whatever. So that had a big effect here. It basically shut down what had been a bipartisan cause. And that means we're now in era 3, which is the era of consequences. And those consequences are real, and they're showing up first in the insurance sector. Why are they showing up in the insurance sector? Because the insurance sector makes trillion-dollar bets, anticipating what is going to happen in the real world, and also has a fiduciary duty to its shareholders and others to get it right. They're under a legal obligation not to lie about the future, contra the fossil fuel industry, which is constantly lying about the future. So what does it look like as the insurance industry looks forward? Well, not good. And what we're seeing is insurance markets melting down, both in states around the country, but also in specific areas. This is the first map that we did in the budget committee showing county by county how the effect was coming through. You'll recall that the way this works was probably originally laid out most clearly by the chief economist for Freddie Mac. No, not a green organization, a mortgage organization, saying that when you couldn't predict insurance risk, you couldn't get insurance. When you couldn't get insurance, you couldn't get a mortgage. When you couldn't get a mortgage, your property value crashed. And the coastal property value crash that he warned of would be as bad as the 2008 mortgage meltdown. Anybody who lived through that knows that was a pretty bad time. Since then, as you see from this map, a lot of the risk has emerged in wildfire areas, not coastal areas. So that's an added avenue of risk equivalent to the coastal property risk that he predicted could lead to a 2008 style recession. Now you've got the evil sibling of wildfire risk starting that same cascade of risk to insurance to mortgage to property values to recession. And after we did that, First Street came out and did their version, which they had better video faculties and facilities than we did. So theirs looks really nice. And what these efforts looked at were, where are premiums spiking? Where are non-renewals spiking? A moment on non-renewals. A non-renewal is when a company that has a loyal customer, that is already their customer, that has been paying premiums to them for years, is suddenly fired by the company. It's kind of unusual corporate behavior to fire good clients. But here it's because the risk has gotten out of hand. It's not the client, it's the property. It's the risk. And so that's why the non-renewals are popping. And where they aren't non-renewing, they're watching their finances by raising rates as much as doubling and tripling rates. I mean, shocking increases, not small increases. Down here in Miami-Dade, the average home insurance cost per year is $17,000. First Street predicts that around the country it's going to be doubling and tripling and quadrupling again during the term of a 30-year mortgage. So in addition to the property value crash of your property suddenly becoming unmortgageable, there's also the problem, even if somebody could get a mortgage, what are you willing to pay for a property that has a $30,000 or $40,000 per year annual carrying cost to pay for the insurance predicted? So both of those burdens fall heavily on valuation. So that's where we are. Florida is kind of first and worst. And around Florida, you've not only seen the insurance problem happening in real time with real people, but you've also seen efforts to shore up the Florida market to keep it going. These efforts to shore up the Florida market are not very credible or sustainable. You have the major companies that have left. You've got what I call pop-up insurance companies filling the gap. Florida's had to create a fund to make good on the claims when the pop-up insurers go bust. A dozen have gone bust already, so this is a repeated phenomenon. Behind that stands Citizens Property Insurance, a state-backed entity that has already admitted that there are scenarios that they've looked at where they can't pay claims. You have claims experience from recent storms where 75% of claims were rejected. 75%. And when people are asked about that, they'll say, oh, fraud. Right. 75% of Floridians are fraudsters? I don't think so. I think if there's any fraud, it's fraud in the insurance marketplace, putting out fake policies and trying to dodge the obligation to pay. So we are really up against it. I'll just give you, this is what do senators know, right? So let me just do a quick run through some of the, what I would call validators who have spoken about this. Fed Chair Powell, a month ago, here in the Senate, 10 to 15 years, regions of the country with no mortgages because of this. The Mortgage Bankers Association, the lobby group, chronic physical risk associated with climate change may also exceed the capacity of insurance and government assistance to sustain some areas. Exact same point. A year ago, The Economist magazine had its cover article saying that this was going to cascade into a $25 trillion hit to the global real estate market. 25 trillion is a pretty darn big number. The International Financial Stability Board warns international banking systems of risks, and it has flagged this specific risk because of loss of mortgage revenue and also because of collapse of loan-to-value ratios in banks. Once the property values crash down, then your loan-to-value ratio goes, and insolvency can be a result. First Street Foundation, we just showed. Freddie Mac's former chief economist, I already discussed. Commodities Future Trading Commission in 2020 said that climate change poses systemic risks to the U.S. Economy, potentially undermining the entire U.S. financial system. And Deloitte, the consulting firm, has said, if we get climate right by 2070, we'll have improved our economic projections by about $43 trillion. If we get climate wrong, we'll take a $170 trillion global GDP hit. That is a swing of $220 plus trillion ahead of us if we continue to get this wrong. And the reason we continue to get this wrong is also wrong in and of itself. It is political pressure from the fossil fuel industry with the powers that the Citizens United decision unleashed, and it is no good. So we are in big trouble. Oh, by the way, their motivation to do this is that the IMF says that the fossil fuel industry floats in the United States on a $700 billion annual subsidy. That's what they get from not having to pay the negative externalities, to use economic Z's, the harms that they cause, which by economic theory ought to be in the price of the product. If you're operating in a market, the negative externalities, the harms of a product should be in the price of the product. And they have dodged that. It's their free to pollute business model. The protection of that is what requires this massive political effort to block things in Congress, lie to the American people, and protect their nasty, morally, environmentally, and economically wrong business model. So the funds run out of this. What we have left to climate safety is a narrow path, and we really need to make sure we focus on it. And I'll close by pointing out that the European Union's carbon border adjustment mechanism, the global carbon tariff, is probably our best avenue to climate safety. The UK is joining the EU. The new Australian government is likely to follow. Canada, I hope, will as well. Nobody knows this financial risk better than Mark Carney, who talked about it for years as the chairman of the Bank of Canada, the Bank of England. So there's still a narrow path, but it's very, very narrow, and we have to seize it with real force and vigor. Thank you very much.
Thank you, Mr. Thank you very much for joining us today, and we really appreciate, again, your great team and all of your help with the room and everything. Do you have a second for a quick question?
Sure.
That's all right. And first of all, thanks for your map. It's a great day to bring up, talk about a lot of the points that you raised in our briefing. But when you go back to Rhode Island, you're talking to ordinary people. You're talking to people, even though Rhode Island isn't very dark on that map in terms of relationships. What are your constituents saying about this issue? What are other stakeholders with interests in Rhode Island as a coastal state? What are you hearing from ordinary people and ordinary business people about this issue?
Well, Rhode Island's a pretty small state, population of 1 million. A lot of us know each other. 2 degrees of separation is a lot in Rhode Island. There's a guy named Ernie Shgalian, who is one of our leading insurance brokers, runs his own company. And he's been a pretty helpful voice on explaining how, while Florida is first and worst, we are already starting to see things, the tremors in Rhode Island. Our banks are concerned. Our insurance agents, not just Ernie, are concerned. Realtors are concerned. So pretty much anybody who's looking forward with a financial future that depends on a robust real estate market supported by a robust insurance market is worried. And then, of course, we've got the people who are looking out for, if you go to Newport, which I strongly recommend, it's a wonderful place to go, there's an area called the Point, which was developed in the 18th century on fill and has some of the most beautiful colonial houses in the country that were developed there when Rhode Island was fabulously wealthy and people built these houses in this area. And now we're looking at flooding of that area. And what on earth are we going to do with all those historic homes? Can they all be put on stilts? What does that do to the neighborhood? The whole thing is, it's a real and immediate problem for a lot of the historic preservation folks as well.
Well, thank you so much for your leadership on this issue and on climate solutions in general. I think you may be having to leave. Is that okay? So again, I know you've got a busy day, you got votes and everything.
Signal yes.
Thank you so much for joining us.
Thank you very much for doing this. Look forward to working with you.
All right, I'm going to switch microphones. Get rid of this one. Thank you very much. Well, that was fun. He knows what he's talking about. Again, thanks, Jonathan and Amy and everyone for all your help today. That was really, really fun, but not fun in a happy fun. It's, I think, a good reality check. These are big macro issues, and they also have very real consequences for ordinary households and ordinary people in Rhode Island and other parts. We are going to commence with the rest of our briefing. We have a tremendous panelist. Before I get to them, I'm just going to say a few words about EESI. For more than 40 years, we have brought nonpartisan science-based information to Capitol Hill. We were founded by a bipartisan group of members of Congress. And since 1984, we've done our best to bring environmental, energy, and climate change topics to policymakers and the public, exactly the kinds of issues that we're going to be talking about today. We've always focused on the multiple benefits of win-win climate solutions like energy affordability, better economic outcomes, enhanced grid resilience and readiness, and improved national security, as well as international competitiveness for U.S. companies. Oops, I'm just carrying this around. I might as well put it to use. There we go. All right. What does congressional education look like? Well, it looks like this. We get together with tremendous panelists, with leaders on Capitol Hill to talk about these issues, to learn about how these issues are affecting people, what types of solutions, especially win-win solutions, are available to us. We also do a lot more than just briefings. We do a lot of articles, issue briefs, fact sheets, podcasts around the full scope of climate change issues. Earlier today, today's every other Tuesday. Today was one of those Tuesdays. Earlier today, our Climate Change Solutions newsletter was issued or published. If you haven't already subscribed to Climate Change Solutions, I encourage you to do that. It's the best way to keep up with everything we do, and you can do that by visiting us at www.eesi.org. In terms of other briefings, other topics, we have a briefing earlier this year on the budget and appropriations process, which is a pretty good one. We've been looking at surface transportation, reauthorization topics, climate modeling, solutions and jobs, and keeping up with us is best done through that newsletter. We do our best to make sure that our resources are timely, relevant, accessible, and practical. We put a lot of thought into when these resources are available, so congressional staff have access to them before you even know you need to have access to them. It's always better to have a resource like EESI before your boss asks you a tough question. If anyone has to, maybe you go back to your office today and say, hey, what's a non-renewal rate in the insurance industry? And you could say, well, I was at this EESI briefing today and Senator Whitehouse talked all about that. That's exactly what we're doing and with these briefings. You can always count on us to help with that. Today, though, we're going to be talking about insurance, and I'm always behind on these. So there's policymaker education. That's what briefings look like. We do about 24 briefings a year. Upcoming briefings, we've got some great ones in the pipeline. I definitely encourage you. Some of those are in person, some of those are online only. Yeah, I'll leave that for there. But today we're talking about insurance, and insurance is probably underappreciated by most people, except, of course, people like Jake from State Farm, Flo and the rest of the Progressive gang, and a certain indomitable gecko and his caveman friends. But seriously, insurance makes the world go round. Insurance for our cars, for our houses, for our health, for our lives. Insurance truly makes modern life possible. Without it, without the ability to collectively manage risk, we would all be consumed with dread about catastrophic loss. And insurance helps us separate ourselves from that dread quite a lot. And like a lot of things, climate change is changing the game as we try to play it. Insurance premiums have increased by about 21% since 2015. Almost 2/3 of US homes are underinsured. This raises significant questions about the ability of American households to affordably manage the risks they face from increasingly severe and frequent disasters like wildfires and storm-induced flooding. And in response, insurers have developed or are developing new and improved products like parametric insurance and climate endorsements to respond to climate impacts and help people live their lives. And while insurance is generally regulated by states, as you heard from Senator Whitehouse, it's critical for federal policymakers to understand how insurance markets are changing, where policy interventions could help manage new and evolving risks, and what that means for us as individuals and households, as well as communities and society at large. If you have a moment and you'd like to take our survey, we read every response. If you have any thoughts about the briefing today or ideas for future topics, if you're in our quite robust online audience, if you have any issues with the webcast or the audio, please let us know. It only takes a few moments, but we really appreciate everyone's willingness to provide that feedback. So, that brings us to our first of three panelists today. Dominick Dusseau is a research associate at the Woodwell Climate Research Center. And if you don't know Woodwell yet, you got to talk to Laura in the back. You got to visit them online. Woodwell is a tremendous resource. Dom analyzes data from climate models to provide actionable physical climate risk information to decision makers with a particular focus on flood risk. Dom builds models to dynamically simulate urban flooding. He created Diluvium DEM, a new global coastal digital evaluation model to estimate sea level rise and inundation risk. Dom, it's kind of hard to, this is kind of an awkward scenario, but Dom, thank you so much for joining us today. I'll invite you to the lectern. I'll give you over the clicker and I'll take my name tent. And I'm looking forward to your presentation.
All right, thank you. I first want to thank Senator Whitehouse, his office, and EESI for organizing this event and for the opportunity to speak today. My presentation will focus on three topics in the insurance industry: catastrophe models, the state regulation of insurance, and the National Flood Insurance Program. Myself and my colleague at the Woodwell Climate Research Center, Jamie Cummings, have co-authored a policy brief on this topic and a few other issues regarding insurance, and we encourage all of you to grab a copy and take a look. Before I get into what catastrophe models are, I first want to emphasize why we're talking about them and their role in the insurance industry. But to do that, we first have to go into how premiums are calculated. Premiums are the sum of three things: the average annual loss, which is the expected amount in claims that insurers are going to pay each year for their portfolio of policies; the expense load, which are the costs associated with administering insurance, and this is underwriting policies or adjusting losses; and the risk load, which is the amount that insurers add to premiums so they can build up a capital in the event of a catastrophic loss, as well as an amount for profit. So catastrophe models are used to calculate two out of these three components: average annual loss and risk load, which makes them incredibly important tools in the insurance industry, and their performance has a profound impact on the premiums of millions of Americans. Catastrophe models are complex pieces of software. They can run thousands of lines of code long, but at their core, they model and estimate the financial losses of extreme weather events or earthquakes, flooding, hurricanes, wildfire, and they can generally be broken down into 5 modules. I won't go into detail of how each module works, but what I'd like for you to take away from this slide is that these are really complex tools that require the expertise of various fields of study, such as atmospheric science, computer science, actuaries, and engineers. The true value of catastrophe models lies in their ability to go beyond what we know in the historical record. They are, we as a society have a pretty limited view in terms of disaster losses. Going back 50 years, we really don't know how much hurricanes cost. In terms of wildfires, it only goes back a few decades. And to add to that, if an extreme event happened today, compared to the same one that happened 100 years ago, it would have dramatically more significant consequences. So if the Great Hurricane of 1926 hit Miami, the same hurricane hit today, we would have significantly greater losses simply because there are more structures and more people in harm's way. So catastrophe models allow us to go beyond the historical record. They allow us to estimate these extreme events, and that data, those estimates, go into the premiums that insurers charge. But as with any model, there are limitations. So this chart shows the loss estimates for the 100-year hurricane wind event in Florida for the same portfolio of properties across different models. The blue bars represent the median estimates, and the black bars represent the uncertainty range. And what we can see is not only is the uncertainty range quite wide, but also the median estimates vary significantly. And insurers would be justified in using any of these values. So depending on what model insurers use, the premiums would be significantly different. And so this is one of the reasons that greater review and regulation of these models is necessary, so that the risk associated in those premiums are calculated accordingly. And so this is one of the recommendations that we put forward in the policy brief that I mentioned earlier. But as you know, so insurers can use catastrophe models generally, by and large, to calculate premiums. But whether they get to use those premiums is a different story. Insurance is regulated at the state level. So if an insurer wants to change what premiums they want to charge, they have to go to each state that they operate in and file a rate change. And so some states are a little bit looser in regulation, and they allow a little more room for insurers to move around what premiums they want to charge. These would be the low and middle regulation states, while other states play a greater role in limiting how much insurers can increase their premiums. This would be the high regulation states. And so what we can see here in this graph is these orange dots represent the high regulation states. This would be something like California. And what we can see is that as the climate risk increases, this is through the x-axis of the expected loss per housing unit, the premiums don't increase accordingly. So what's happening is this dichotomy of the environment where the premiums in these high-risk states not only do not reflect the climate risk, but they're being subsidized by the premiums in the low and middle regulation states. And so one of the things that we think could really alleviate this issue is moving some of the regulation from the state level to the federal level in something called an optional federal charter, where the insurer gets to choose if they want to be regulated at the state or the federal level. And this would reduce some of that cross subsidization and reduce regulatory costs, and hopefully bring down some of those premiums. At this point, I'd like to transition to the National Flood Insurance Program. So by and large, home insurance does not cover flood damages. And so this is where the flood insurance program comes in. A couple of years ago, the program changed to an actuarially based system, meaning that policies represent the true cost of a property. This is what's known as risk rating 2.0. Current premiums are on a glide path. Current policies are on a glide path from their current premiums to the true risk rate, while new policies are calculated using that new actuarial framework. So they represent the true risk rate. And generally over the last 10 years, the trend has been that policies have gone down while the average premium has gone up. And what Congress could do in terms of alleviating some of this issue is providing a means-based insurance assistance program so that low-income households could maintain their coverage and possibly expand some of that coverage in other parts of the country. One part of the National Flood Insurance Program is the community rating system. The community rating system is a program where communities get to implement flood risk reduction measures in exchange for flood insurance discounts for the residents in their community. So this could be like preserving open space, stormwater management, levee maintenance. The greater the number of activities, the greater the discount. So on face value, this seems like a great deal. You get reduced insurance premiums for risk reduction measures. But as I mentioned earlier, there are, right now, the FEMA is using an actuarially based approach, meaning that the activities that communities implement are already incorporated into the premiums that are charged. So the wetland that is restored for storm surge attenuation, the building that was elevated or moved out of the floodplain, those activities are already in the catastrophe models that underpin the premium calculations. So this is to say that the policyholders are receiving the discount twice. The first time is when those premiums go down to that risk reduction activity. And the second time is when they receive the discount from FEMA. And so to get that money back, FEMA has to incorporate a cross-subsidization program. And so to visualize how this works, we can take a state where there are two communities. One has a 30% discount, community A, and the second has 0% discount. FEMA then calculates the state average discount, in this case would be 15%, and then adds it back into the policies of those communities. So we end up with a community A, which originally started with a 30% discount becoming a 15% discount. And community B is now paying a 15% surcharge to subsidize the discounts of community A. And so nationally, how this plays out, you can see this map of different states where some have a very significant inequality in terms of the amount that they're paying to subsidize those discounts. So the green counties here are those that are receiving discounts, while the orange, red, and purple are the ones that are subsidizing those discounts. And we can see a zoomed in portion here of Georgia where 3 counties are receiving discounts while the majority are paying for those. The greatest pattern, or the most prominent one that we can see, is that rural counties, those that are under-resourced, are largely paying for these subsidies in high-risk communities, in communities that have a great number of policies, and also those that have a high CRS discount. And so, as previously as I mentioned, the FEMA is currently using an actuarially based system. So premiums are in a glide path, meaning that at one point in time, they're going to come to their true risk rate. So as you can see in the map on the right, this represents the full implementation of risk rating 2.0. So all those counties and communities that have high risk are at one point in time going to be seeing much higher premiums. And we can see how there is a general darkening in terms of the colors of those subsidies. So rural communities are going to be paying even more to subsidize the discounts of those communities. And so Congress, in conversation with FEMA and communities nationwide, could reform the program and discontinue these subsidies while maintaining some of the benefits of the community rating system. And that's, thank you very much.
Thank you, Dom. That was a great presentation. After our third panelist today, we're going to have time for questions. So for folks in the room, you'll have an opportunity to ask questions. If you are in our online audience, you can send us questions by sending an email to ask, that's ask@eesi.org. Dom just presented some really great slides. There are printouts of those slides on the front table or the check-in table outside the room. They're also available on the website. So if you go to eesi.org, and you go to the briefing page, you can download all of the presentation materials from all of our panelists today to go back and take a closer look. And the live cast will be available as well, an archive of that. So if you want to go back and rewatch any of the presentations or rewatch what Senator Whitehouse had to say, that's absolutely possible as well. That brings us to Benjamin Keys. Ben is the Rowan Family Foundation Professor of Real Estate and Finance at the University of Pennsylvania's Wharton School and a research associate of the National Bureau of Economic Research. Ben's recent research has focused on climate risk, housing and mortgage markets, foreign investments in the U.S., and the geography of household financial distress. Before joining Wharton, Ben taught at the University of Chicago and worked as a staff economist at the Board of Governors of the Federal Reserve System. Ben, thanks for being here today. I'll turn it over to you.
My name up there. All right. Good afternoon, everyone. Thank you so much to EESI for having me. It's great to be here and to be talking to you about insurance. We heard from Senator Whitehouse, who I think did actually a pretty nice job kind of laying out the chain of risks when we're thinking about why should we care about insurance. In order to take on a mortgage, you need to be able to have insurance. And the housing market runs on mortgages. The average home buyer is putting down about 10% when they buy a house. So 90% of that exposure is held by the mortgage industry. And so when we're thinking about the risks that are facing communities, insurance should be front and center when we're thinking about those risks. More generally, my research has been focused on thinking about how climate change is affecting the built environment, how we're thinking about durable assets that are sitting in one place and that are fixed, right? You can't move entire buildings or communities very easily. And so how are we going to think about addressing the challenges that those communities face? The immediate source of pain is coming through the insurance market, as Senator Whitehouse laid out. It's also reflected in that market because they are the easiest to reprice. Insurance markets are highly liquid, highly responsive, and they're writing annual contracts. And so when we're thinking about a liquid financial market that's going to reprice risk, we should be thinking about reinsurance and insurance markets as sending some of the first and clearest signals about climate risk to this broader chain of mortgage and housing markets. When my co-author Phil Mulder and I started looking into the risks that are associated with climate change in the housing market, we kept hearing, well, this is a problem for the insurers. This isn't the mortgage market's problem. This isn't the realtor's problem. This is the insurer's problem. And we said, okay, where can we get our hands on some decent insurance data? And we found it was very challenging to do so. So what I'm going to tell you about today is, at first, is talk about the data efforts that we've been undertaking these last few years. In terms of data on the availability of policies, I want to commend Senator Whitehouse and his staff with the Senate Budget Committee in the previous year to pull together unprecedented data on non-renewals. So that's new data that's being made available to the public on where insurers are canceling policies. There's also new data that's come out of FIO, out of the Federal Insurance Office from the Treasury, that is, again, unprecedented data. And what I'm going to share today is unprecedented data on premiums that we've derived from mortgage escrow payments. So rather than getting data from the insurance industry, we did an end around. We went to look under the streetlight. There's lots of good data from the mortgage market, and I'm going to tell you about the data that we pulled together there. So what we've done is we've backed out how much people are paying in their insurance premiums by looking at their escrow payments. So some of you are too young to have a mortgage, but when you do have a mortgage, what you commonly do is you make a monthly payment that's going to cover the principal, the interest, the taxes, and the insurance. And we've backed out how much of that payment is going towards insurance. I think that's on my next slide. What we do in the paper that we released last summer and that we're currently in the process of updating and revising is looking at where insurance premiums have changed over the last 10 years, estimating a time-varying relationship between those premiums and different estimates of local disaster risk, and then tried to explain why we've seen these sharp increases in premiums. Okay, so a little bit about our method. As I said before, principal, interest, taxes, and insurance. And so you need data on each of those components. When we see the monthly payment, we have data from CoreLogic's loan level mortgage analytics database, and it's basically subtraction. Take the total payment, subtract off the principal payment, the interest payment, and the taxes, and what you're left with is insurance. That can get messy with private mortgage insurance. There's tons of stuff in the paper that we deal with, but what this leaves us with is 84 million premium estimates across the country from 2014 to 2024. That's on a subset of homeowners who pay their homeowners insurance policy through the escrow account, right? So this is money that is collected by a third-party mortgage servicer, and then they're the ones making the direct insurance payments. Once you put this all together, you're able to make maps like this. So this is like county level data. I always feel a little bit like a weatherman when this is posted, but what do you see sort of jump out at you here in terms of the different shadings of colors? You know, as we see some of the red and dark red areas along the Gulf Coast in southern tip of Florida, but we also see that in parts of the Northeast. Vermont sticks out as an area that has suffered a couple of large disasters in recent years. And then I think, you know, it's often a surprise to people to see the center of the country being so red, right? These are areas where in many cases home values are quite low, but this is a response to convective storms and hail in particular. A tremendous amount of claims related to those risks and a growing risk, substantial increases in the frequency of hailstorms, the size of the hail. And so all of these things are driving premiums up sharply in the middle of the country. You also see wildfire risks out further west. We can zoom in with our data to go all the way down to the zip code level. So we've produced zip code level maps for a number of cities that have asked for the data. If you are interested in getting some finer geographic data, it is something that me and my team can try to pull together. We've produced state level maps, congressional district level maps as well. And you can see the gradient here as you move away from the beach in Miami, that you see differences in the costs of insurance. One of the most dramatic things that we've been able to do with the data is put together this figure and the next figure. So this is just showing for the country average annual premiums since 2014. What you see is only a very gradual increase from 2014 to 2021, and then a massive acceleration, right? This, you know, Al Gore talked about the hockey stick graph. Like, this is an extreme hockey stick situation. Our estimate is that premiums have increased 48% from 2020 to 2024 nationwide, and that's 20% in real terms, so dramatically faster than inflation. If we break this out across different risk quintiles, so we've grouped all the zip codes in the country by their expected disaster losses. And what you see is that this is really a high-risk story, that the high-risk zip codes have seen a disproportionate increase in their insurance premiums. And annual premiums have increased in this top 20% of zip codes by over $1,100 in just the last 4 years. And so this is a dramatic increase that is borne by homeowners. One of the things about our data is this is just the premium that they're paying. We don't see what coverage they have. And so you would think that as premiums are going up, households are going to respond by taking on less coverage that has more holes in it, that covers fewer perils, that has higher deductibles, and so on and so forth. And that's what we're working on, getting our hands on data that can look at the household response to these sharp increases. What we're seeing here is ex post. This is what people are actually paying. I think this helps to rule out a certain set of stories about why we've seen premiums rise. This is not just an inflation everywhere kind of story. This is changing disproportionately in the riskiest areas. And one of the things that we've tried to drill into is how much of this is due to what's happening in capital markets and the cost of reinsurance. So, if there's anything that's more boring than talking about insurance, it's talking about reinsurance, which is insurance for insurance companies. But basically, we've seen an enormous tightening of that market, that it's been very difficult for the big global players like Swiss Re or other entities to meet their costs of capital as we've seen sharply rising interest rates. And they have sharply reduced the policies that they're willing to write for insurance companies in the United States. They're charging much higher prices, or they're not writing those policies at all. And so insurers are shifting where they're going to write their policies subsequently. They're leaving those markets, like in the map that Senator Whitehouse showed, and they're sharply increasing the premiums where they're allowed to do so. This slide wasn't supposed to look quite like this, but we estimate that premiums increased nearly 50% between 2020 and 2024. And we do some more involved calculations in the paper, which suggests that about 50% of that increase is rising structure values. So that's inflation, but it's also the cost of labor and materials and the buildings themselves. And about 30% is due to this shift in how insurers are pricing risk. They're pricing risk at the high end differently than how they were pricing it just a few years before. So zip codes with more correlated concentrated risk saw larger increases in premiums, suggesting that there's a reinsurance shock. That's an important component to this, that capital markets really matter, and those liquid, less regulated markets with less frictions are the ones that are driving the pass-through into prices. We also show that it then affected home prices. So this chain that Senator Whitehouse was talking about, it passes through from the reinsurers to the insurers to home values. And we're seeing a relative decrease in the home values in the areas that are most exposed. I think you're starting to see this play out, if people don't mind me bouncing around from the pictures. If we go back to Southwest Florida in particular, if we look along the Gulf Coast of Louisiana, this is where we're seeing big increases in home inventories, unsold homes that are listed for sale, but there are no buyers at the price that the seller is looking for. More time on the market and more failed sales, and that's usually a very strong predictor of subsequent home price declines. Okay, so in my remaining 2 minutes, I want to think ahead a bit. I think there are a lot of reasons why premiums have increased, but I think a very important and underappreciated one is limited capital to cover catastrophic risk. These higher premiums are absolutely affecting housing and mortgage markets. They're affecting housing markets in this willingness to pay for the higher carrying costs of insurance. They're affecting mortgage markets because many home buyers are bumping up against debt to income limits when they apply for a mortgage, and a higher insurance bill is rolled into that debt service cost. So more people are not able to qualify for a mortgage when insurance premiums are high. I think the implication of our research that is not necessarily obvious is that it partly depends on the efficiency of markets for how they're going to share and price catastrophic risk. That's going to determine the cost of insurance and ultimately the signal that is sent to markets and market participants about where to live, where to build, where should developers put up the next housing development? Should it be along the coast? Should it be in a risky area that's exposed to wildfires? Part of that is going to be a response to the cost of insurance, and the cost of insurance is in part determined by capital markets, not just by the climate forecasts. So we need to think about incorporating both of those things. And that's going to create a need for market innovations and policy solutions for ensuring these kinds of correlated catastrophic risks. I think we've seen this already where states that are more tightly regulated, we're seeing insurers exit. And so regulating insurers just on price alone is going to be an inconsistent and incomplete way of regulating these markets. It just pushes the risk onto these state-backed plans. And then, whether we are going to get the price signals that will induce large-scale adaptation is a big remaining question. I think finally, as we take a step and think about what can policymakers do, like, okay, where are the opportunities for action? Clearly, there is a need for more data and better data and models. And that's something that we already heard from in talking about the availability of these catastrophic models, right? Florida is unique in that they have a public entity that reviews catastrophic risk models and communicates the learnings from those models more generally. But we need weather and climate forecasts to be public and available for all. This is not the time to be cutting funding for weather and climate data that we all use every day on our phones when we're checking the weather app, but more generally that insurers and reinsurers need to build their models on top of. There's a variety of misaligned incentives that got us into this situation in the first place when we think about where we've built over the last 40 years and some of the risks associated with it. But I think there's some risks that we could think about dealing with through the mortgage market, that the mortgage market sits in a nice place when we think about having a longer term outlook rather than writing annual policies and deciding, should I write a policy? What should I charge? They can take on some of these longer term risks and coordinate resiliency investments. The reinsurance market's hardening, basically a doubling of the cost of a standard reinsurance policy I think creates a need for policymakers to intervene because homeowners and the mortgage market need continuous coverage, right? And so when continuous coverage is the requirement, we need available capital for reinsurance. I think that creates an environment where having some sort of public backstop to provide continuous availability is essential. So I think exploring a public federal reinsurer is a promising direction. And then ultimately, we need to reduce our risks. And that needs to be done at the homeowner level when we're thinking about homeowner education and what can you do to make your home hardened against some disasters. But it also applies at community levels and state levels and federal levels. I think we need to invest and experiment in resiliency efforts on the ground. Some of that should be done with subsidized financing because a lot of these investments don't pay for themselves right away. So encouraging homeowners to borrow $10,000 or $20,000 against the enormous amount of home equity they've built up in recent years. We have $35 trillion of home equity in the United States. Some of the biggest beneficiaries have been in exactly those risky areas. And so putting a little bit of that home equity towards resiliency is a step in the right direction. Financial products that could come from Freddie Mac, Fannie Mae, or private capital to make homes more resilient. Tax advantage disaster readiness accounts are another promising direction. And ultimately, the way in which we reduce risk is we bend the risk curve, and that's by decarbonizing the economy more generally. I'm going to stop there. I'm out of time, but I look forward to the conversation, and thanks again for having me.
Thank you, Ben. Here's your name pin.
Oh, thanks.
Thank you very much. So this is we're having the briefing today, but we've actually been talking and covering insurance and some other resources. And so I just wanted to plug our, not the podcast episode that released today, but the one that came out last week. Allison, my colleague, and I co-hosted an episode with Lisa Dale from the Columbia Climate School, and we talked specifically about insurance and wildfires. And so if you haven't checked that episode out, it was a really interesting conversation, and we went into kind of a deeper dive. We didn't really cover reinsurance. I don't know. I think this is one of those things where maybe it's a little boring, but I'm not sure we have the luxury of ignoring it for a whole lot longer. That brings us to our third panelist of the day. Carolyn Kousky is the Associate Vice President for Economics and Policy at the Environmental Defense Fund. Carolyn's research examines multiple aspects of climate risk management and policy approaches for increasing resilience. Carolyn has worked with many communities on resilience strategies and developing inclusive models for insurance and disaster recovery. She's the Vice Chair of the California Climate Insurance Working Group, a university fellow at Resources for the Future, and a non-resident scholar at the Insurance Information Institute, a member of the Roundtable on Risk and Resilience of Extreme Events and the National Academies of Sciences, Engineering, and Medicine, and she's the founder of Insurance for Good. Carolyn, I don't know how you have time to join us today with all of your affiliations, but we're so happy to have you, and I'm really looking forward to your presentation.
Thank you. It's really great to be here with you today and to talk about these issues. Let's get this set up. So I'm going to talk about our future insurability. Before I do that, I want to take just 30 seconds to talk about Insurance for Good, because we have just recently founded a new nonprofit that's focused on helping communities, NGOs, and the public sector with developing and identifying risk transfer solutions that can support their social and environmental goals. We do that through 4 big buckets of activity. We curate trusted resources through our newsletter, blog, and website. We host a whole range of education and capacity building activities at different geographies on different topics. We have something called our Solutions Catalyst, where we partner with communities on innovative new insurance approaches, and then we engage in policy and regulatory reform to make sure we have the institutional structure in place so that insurance can be a force for good. And it can be a force for good. And I want to start there with sort of why, and you've heard this, a bunch of different perspectives on this today, but why I think this conversation about insurance is really important. And that's because there's a growing body of research by myself and colleagues that shows how absolutely critical insurance is for people's recovery. We find that households with insurance have fewer unmet needs and fewer financial burdens in the short and longer run. Insured households have faster recoveries. They are more likely to rebuild. There's some nice sociology research that lack of insurance actually widens income inequality post-disaster. Households with insurance repair, get back in their homes, sometimes even are able to undertake upgrades, whereas those without insurance spiral into increasingly difficult levels of financial precarity. And then there's another body of research that shows that lack of financial resources generally to deal with the extreme financial shock that disasters are for households has negative impacts into all areas of life. Poor physical health, emotional health and well-being, educational attainment of the children, and so on. The benefits that you get from insurance, the reason behind that's really obvious, which is there's no other good source of dollars for covering this huge expenditure shock and sometimes an income dip that disasters impose on households. We could spend a whole thing on this, but our federal aid system for households was not designed to replace insurance. People typically get a few $1,000s. We've looked at the aid programs, and Ben could say more, or the loan programs, Ben could say more about this, but we see that as income goes down, loan denials go up. So post-disaster loans are not a universal source for helping households with these dollars. And so that, really leaves insurance. And that's why we see these benefits, not just for a household, but also into the broader economy, as you've already heard talked about a lot today. We find that as more households in a community have insurance, we see increasing visitations to local businesses. Because when you have the dollars, again, you're able to more fully and quickly participate in the local economy. And you've already heard about the benefits to lenders and the GSEs from insurance. So all of these great benefits are why it's really concerning the situation we find ourselves in right now, which I think is, as climate is increasing the frequency and severity of disaster events, insurance is becoming ever more important because more households are suffering through disaster and need that financial protection. And yet at the same time, we need this tool more than ever. Our insurance markets are under stress and it's becoming harder and more expensive to provide. We've seen a number of trends emerging recently. You've heard about a number of these, escalating prices. You just saw some great maps about how that's happening around the country, and there's a number of different drivers for that. Some of the trends are more localized. We've seen in certain high-risk areas, insurers not renewing policies, exiting markets. We've also seen a lot of growing anecdotal evidence of restrictions and coverage in those policy terms, putting more of the risk back onto the household. We've seen localized insolvencies, which you heard about earlier in Louisiana and Florida. And all of this pullback in the private sector is creating a migration of risk into our public sector programs. Every state at high risk of disaster has what's referred to as a residual market program, a market of last resort for those residents who cannot find or afford coverage in the voluntary private market. I thought we could look at California really quickly, given the recent LA fires. And what we're seeing that we at Insurance for Good has a blog up tracing the kind of dynamics that have been unfolding in California. And what you see is that the kind of destabilization in the insurance market in California really goes back to the 2017 and 18 wildfires, which were the two most devastating until the recent LA blazes. And those fires, insurers paid out more in claims than their cumulative underwriting profit in the entire state over the last 30 years twice over. That is not a viable business model. And so in response, insurers have started rethinking and exiting the risk in California. So you see this spike in pullouts and non-renewals from the highest risk areas. And over here, you see the top line as the high risk areas, a huge increase into the state fair plan because of the pullout in the private sector. Some colleagues and I have been looking at what this means for housing markets. And what we're finding is that in areas where insurance availability goes down, people don't want to move in there anymore. And people choose to move elsewhere because it has impacts on their finances. We also see that that gets capitalized into home values, both insurance availability and insurance pricing. What's happening in California is happening in other states, but actually not all of them. So this is looking at policy counts in those markets of last resort. Florida's always been the biggest. And as you've heard earlier today, lots of these programs are starting to see increases in policy counts as it's getting harder and harder to find coverage in the riskiest areas. So I think that raises two big questions. The first big question, and I'm sure you've seen headlines about this, is our future insurable? And the answer to that depends very much on the choices we make today. There are two ways to think about insurability. There's a technical limit to insurability, and there's an economic limit to insurability. So technically, insurance is built on mathematical laws that create benefits from risk pooling. And climate is now changing the loss distributions at both ends. It's making some risks too frequent to cost effectively insure anymore, and it's making some too severe in order to cost effectively insure anymore. So climate is shrinking our sort of window of insurability. But long before we get to technical limits of insurability, we hit economic limits of insurability. And that just means that the price at which the private market can cover the risk exceeds what anyone is willing or able to pay. And if you can't afford it, the market breaks down, you don't get market clearing. And what we've seen going back decades and decades is that when that happens in disaster insurance markets, governments step in and they start to provide the coverage. And we can talk about how those are designed. We engage in a lot. There's lots of lessons learned from these programs around the world. But at the end of the day, someone has to pay the cost of risk. And so the only long-term solution to these dynamics we're seeing in our insurance market is risk reduction, which you've also heard today. And we know how to build, I don't know what I did there. We know how to build safer homes and communities. We know how to keep Americans safe from hurricanes, from wildfires. We just need to start doing it. And this is things like building codes and land use decisions. Because insurability is not a yes-no proposition, it is a spectrum. And while climate is making it harder to insure, investments in risk reduction are making it a lot easier to insure. I also wanted to quickly flag, and maybe we can talk about it in the Q&A, but there are also lots of innovations happening in the insurance market that are also working to expand the realm of insurability. So for instance, we've been working on parametric microinsurance, which has grown up decades ago in other countries, and it harnesses new data and technology and mobile platforms in order to write smaller insurance contracts than we could otherwise. There's a number of things that insurers can do to support these investments in risk reduction. We could talk more about them in the Q&A again, from providing more dollars in education during rebuilding, because disasters are an opportunity to build back for our climate future. And we should be harnessing those opportunities, to doing a better job communicating to communities about what it means to maintain insurability going forward, to improving the models and data that you heard about earlier that underlie insurance underwriting and pricing to make sure they incorporate risk reduction and in a timely way. And they don't all do that right now. Okay, the second big question that I think gets raised from the dynamics we're seeing now is who is going to pay the cost of climate-related disasters? We could unpack this more, but all of our state programs have been explicitly designed to have substantial cross subsidies in pricing. They are not designed to cover the cost of a huge disaster. And so when they have a big event and cannot pay it, they have assessment authority over insurers or policyholders in the rest of the state. So low risk policyholders and future policyholders pay the cost of today's disaster. That's true in California, that's true in Louisiana, that's true in Florida. And it raises questions about whether we think those cross subsidizations are equitable. What do they do to incentives to invest in risk reduction? And if we're going to be cross subsidizing, do we want to do it in a different way? We've been doing some work focused on what it means to create an inclusive disaster insurance market to help relieve some of the financial burden on low-income households who arguably need the financial protection of insurance the most and are the least able to afford it. We have a report on this if anyone's interested, and look at a range of things from the local scale to the federal to the private sector, everything from means-tested assistance to baseline coverage standards to some of these new business models and the regulatory frameworks that they need. I want to end my last slide just saying a bit, or just one thought on the role of the federal government here, because as you've heard, insurance is regulated at a state level. So a lot of the issues in the markets that we're talking about have to be dealt with at a state level. There are two really important functions that the federal government provides. The first is weather and climate data. All the models you heard talked about, the CAT models that the sector uses, are based on data from NOAA, from NASA, from USGS, and all of that has been removed or is under threat. Restoring that data is critical to future risk assessments for the insurance industry. The second is supporting risk reduction. There previously had been substantial amounts of dollars going to communities, because a lot of these, as you heard, are also public goods. And public goods are underprovided in the private market. And so we're not going to see sufficient investments in risk reduction to stabilize markets without greater support. Okay, that's all I have. Thank you.
I could have listened to a couple more minutes. We had tremendous panelists talking about this really complicated topic and doing so in a super clear way. I'm going to move that to that. All right, so now we're going to dig into our Q&A. EESI's policy director, Anna McGinn, is here with the mic. She'll come around if you have a question. If you do have a question, it's important that you wait for the mic so that our live cast audience can pick up the audio. But to get us started, Carolyn was just talking about some roles of the federal government, and you actually, two quick things. Carolyn, you win the brownie points today. You're the first person to mention building codes, which is something that's, I love building codes, building energy codes. So brownie points to you. And a quick reminder, if you want to go back and revisit the presentations or the live cast, everything is available at www.eesi.org, and you can pick up slides on your way out if you didn't pick them up on your way in. But Carolyn was just talking about things the federal government can do, and she mentioned data, she mentioned pre-disaster mitigation, resilience, things like that. I'd like to start with you, and maybe we can go down the line and we can sort of build on what we've already heard so far. But what are some federal agencies or programs that play a particularly important role in ensuring long-term resilience and therefore investability and insurability in U.S. communities? Yeah.
Okay. Yes, it's a very good question. I think I first want to start with saying that insurance is one part of risk management toolset, as we've heard several different perspectives. And so risk mitigation is a huge component of making sure that it'll decrease your premiums. If you build a better roof, your insurance company's going to account for that. Usually, they should. And that will decrease your premium. For every $1 invested in risk reduction, you get, there's $6 avoided in lumps. So that's a huge, huge return on investment. And so one of the programs that has done that has been unfortunately canceled, that I think Congress should play a bigger role in ensuring its continuation, is the BRIG program. So that's building resilient infrastructure in communities through FEMA. This was a huge pot of money that went to risk reduction, and as climate change makes these disasters more severe, more frequent, those dollars really go a long way. And so not only FEMA has a role to play, but pretty much every agency in the federal government has a role to play to think about climate change. Climate change is not just this environmental issue. It touches every part of our society. And so the more we integrate it into how we think about building, how we build back better, as Carolyn was saying, the better we'll be off. So our future communities and generations won't have to bear that burden.
Great, thanks. And Ben, same question to you. What are some federal programs and agencies that you'd like to call attention to that can do things now that will make insurability easier in the future?
Yeah, I mean, first I'll just say I completely agree with Dom's recommendation. I guess I'll focus on the housing and mortgage side of this. I think when we're thinking about the players in these markets, the housing and mortgage markets are focused on long-term and durable assets. And so I think they have the right incentives and the right perspective for thinking about these risks. If you're writing a 30-year mortgage, you should be worried not just what's insurance cost today, but what's it going to be in 5, 10, or 15 years. So I think Fannie, Freddie, the FHA, and HUD more generally can play a much bigger role in this, recognizing the importance to well-functioning mortgage markets to have a layer of insurance on top of it. As an economist, hearing Senator Whitehouse talk about internalizing externalities is like my heart grew 3 sides of this, right? Like just thinking about someone was listening in Econ 101, but I think Fannie, Freddie, and the FHA are huge beneficiaries of these insurance policies, but have largely allowed the market to operate on their own and sort of historically been kind of a check the box situation. So I'd be really interested in seeing whether those kinds of mortgage entities could get involved in reconciling some of these disconnects in terms of the incentives around building codes and land use around the volatility of annual policy writing, as opposed to something that's more long-term and consistent.
Internalizing externalities would be a good band name as well. Carolyn, I'll give you a few minutes to riff on this a little bit more too. I think you brought this up, and I think it's so important. Even though this is regulated at the state level, there are things the federal government can do. Do you have any more examples that you'd like to share?
Yeah, maybe I'll just expand a little bit. I think it's sometimes not understood or appreciated that in the private insurance market, there are all these private proprietary models that the industry uses, and they are built on a foundation of government data. They will not continue to work well without government data. In addition, all the private sector innovation that there's so much excitement about, there's a lot of potential, are sitting on federal data. For example, the new parametric approaches that we're seeing, they use as triggers data from the National Hurricane Center, from USGS. And it's important that it be government data because it has to be independent from any of the participants in the transaction. And so I think it's really critical to understand that these things that don't seem to be part of insurance are actually deeply embedded into the insurance market. And then, yeah, I of course agree with everything else about risk reduction and mitigation.
Great, thanks. Looking for hands and questions in our audience. Please feel, we have a whole bunch. So they're all on that side of the room. So this side of the room, I think I saw some of the folks in the back go up first, Anna. There's someone with like a white name tag. Yeah, there he is.
Hello, my name's Ian Blair, Wetlands Watch from Virginia. ERISC have recently acquired the NASDAQ CAT model, and ERISC is owned by Swiss Re. I'm curious, what are your thoughts about insurance companies purchasing catastrophic models and doing their own data analysis? Will this help the industry, or should we keep these separate?
Okay, thanks for the question. We'll open that up to the full panel. Anyone like to comment on that? Carolyn, go ahead.
I'll start by saying many reinsurers and insurers have their own models and have for a number of years, so that's not a new thing. And most sort of large scale insurance transactions will use, to what you saw earlier in the kind of variation of the models, multiple vendors in order to compare across them. That maybe doesn't answer the broader question, which is how do we make sure that under-resourced communities and the public sector and households have access to that good information? That's a little bit of the great. Thanks.
Dom or Ben?
Yeah, that's Carol saying. Many insurers do have their own models. And the big insurers definitely do. The smaller insurers, they rely on these independent modeling firms to price their premiums. They also use, these models are also calibrated using loss data, so claims from the insurers themselves. So there's always this cross movement of data between different firms to further improve these models. So it's not necessarily a bad thing that they get more access to this data. As for the long-term question of whether it's a good idea, I can't answer that.
Great, thanks for the question. Oh, go ahead.
I actually expand on that because I actually want to use it to highlight something that Dom said earlier, which I think is important maybe when talking about these models, is there is a concern by regulators, right? That when they're black boxes and proprietary, that we can't see into them, and we as consumer protection regulators, they don't want models that are used to artificially sort of hurt consumers with higher prices, right? And there have been a number of regulatory approaches that are really starting to fix that problem. And I think Don mentioned some of them, but like the state of Florida has been using catastrophe models probably longer than anywhere, given the hurricane risk. And they have an independent commission that looks inside each model and approves it for use in the state and compares it against a state public model as well, and requires a number of outputs to be made publicly available. Lots of states piggyback on that verification work that the state of Florida does. And California right now is standing up something similar, but a little bit different for wildfire models.
Great. Go ahead, Dom. Yep, absolutely. We encourage this type of exchange.
So as Carol was saying, yes, there's a great amount of regulation in Florida, and California is building their own wildfire model. Many states, of course, beyond California are susceptible to wildfires. And so one of the things that might benefit the whole United States is building a national public catastrophe model where many states can benefit from those modeling decisions, and you don't need separate models with different states. It would certainly be cost effective. And that model could be used for greater hazard mitigation planning at various levels of government.
Okay, thanks. I saw a hand, I think, all the way back up against the wall, and then we'll come up to the front of the room. See you, Karen.
Hi. Hi everyone, my name is Kousky with Appalachian Voices. I have kind of an impossible question for the three panelists. We've talked a lot about all the things that are going into these calculations, right? Federal data, the need for funding to the NOAA programs, the NASA programs to have that data, conversations around building codes, land use decisions. In places like Western North Carolina impacted by Hurricane Helene, folks are really focused on rebuilding quickly. And that kind of length of recovery periods from trying to get new codes implemented, kind of pacing forward on that is sometimes painted as a delay in recovery. So I'd be interested if each of you could provide like one talking point for the public and congressional leaders of like how we cut through the noise on the need for insurance, conversations around FEMA benefits for individuals, public assistance, all of that stuff is where we are right now. And it's a really big problem. So kind of an impossible question, but if you just had like one talking point to try to cut through the noise, what would that be on how important insurance is and how all of these investments come together?
Okay, thanks for your question. I'll open it up. Anyone would like to take a stab at that? Go ahead.
Go ahead. Sorry.
Okay, Dom.
Okay, I'll go first. I think maybe one talking point is probably something I'm repeating myself, but that's climate change touches every part of society in our lives, and it will touch you in your insurance, in your home, in your community. So it does affect you no matter where you live, no matter what you do. So hopefully that sense of solidarity that we're all working through this might be something to cut to the most.
Go ahead, Ben.
I mostly echo Dom. I'll say, check your pocketbook, right? The first place that this is really hitting households is through their insurance premiums. And I think a lot of people who have been skeptical about climate change are seeing from the insurance industry, this is a point that Senator Whitehouse made, the insurance industry has the duty to price risk accurately. And so when you see the amount of money, amount of time, the amount of data and resources that they're pouring into trying to understand these risks, trying to price risk accurately and adjusting their decision making on where they write policies and how much they charge for those policies, that should really bring it home for people, that the insurance industry is responding quickly and that it is having a direct effect on your household's finances. And so, certainly that's what I've heard the most is people who are startled when they see the new price of insurance for the coming year. And that is, I think, a great place to start to have those conversations is, okay, your premium went up $600 this year. Let's talk about all of these different elements. And maybe that doesn't get into the minutia of reinsurance, but I think it really hits home for people to, because so many times insurance is set it and forget it, right? You take out an insurance policy when you buy your house, or maybe when you refinance, maybe you just like the Geico commercials, whatever reason you chose the insurer, but you're probably not shopping around all the time. You probably don't know what all the features of your policy are. And so I think that point in time where you get that renewal statement that says, here's the new price of insurance, what the heck happened? Why is this so expensive? That's the opportunity for change.
I think that's a hugely important point because you really do. You do kind of set it and forget it. And it can be a really rude awakening when you're like, oh, wait, my budget, my household budget is based on the fact that I have these payments recurring every month. And then all of a sudden, it's a pretty rude awakening when you get that. Carolyn, I want to give you an opportunity to weigh in too.
I was going to say something different, but actually that triggers something in my head that I think is important, which is that I don't think that we're doing a good enough job communicating that risk is changing year on year. We are locked into escalating risk. We did not decarbonize quickly or fast enough. And so that means for our lifetimes, risk is going up, which means we should not be surprised that insurance premiums are going up. They're not going to stabilize. They're going to keep going up. And those NFIP numbers that we're on trajectory to, those were from years ago. Those haven't even incorporated the fact that flood risk is changing in many locations and it's going to continue to change. And so until we wrap our heads, I think, around this new reality of changing risk, we're going to be always playing catch up, and it's going to be a lot of economic pain. And so if we can kind of shift our thinking, though, and make decisions now for that climate future, we can save ourselves a lot of economic pain. We can build safer houses. We can design communities to withstand some of these events but it requires doing that ahead of time and doing that work. Once the disaster hits, it's late to be putting in your strong building code. And yes, it's good if you can do it, but at that point, people are on their track to rebuild. And at that point, you're not going to get the insurance benefits for code upgrade coverage. If you have your strong building code in place already, which is a large share of the LA homes that burned, they're going to get insurance dollars to rebuild to a wildfire safe level. But the place where the code isn't enforced, they're not going to get the dollars to rebuild safely. So that's problematic. So we need to be doing sort of advanced thinking with this awareness of changing this.
Yeah, the time to do a lot of this was yesterday, unfortunately. I saw you in the red tie, and then we'll make our way over to the front row and we'll give this side of the room some questions too.
Hi, everyone. Thanks for taking the time. My name is Rafiq Hussain. I'm a Canal Ocean Policy Fellow working for Senator Blumenthal here in the Hill. My question has to deal with the loss of grants under FEMA, potentially FEMA going away or being moved somewhere else. And I'd love to hear your perspective on what the loss of these grants are going to do in terms of insurance and your thoughts on how to best, if at all, change FEMA to better protect homeowners and households.
Thanks for your question. I'll open that up to anyone who'd like to comment on BRIC. Go ahead, Carolyn.
Yeah. I mean, I personally think those risk reduction dollars are incredibly important. And I think that program going away is going to create higher levels of inequality in terms of risk safety, because higher income communities and states will figure out financing on their own to do a lot of this. And lower income communities won't be able to. And a lot of those dollars had been targeted at them. So that's something concerning for me. It's also going to mean higher bills on residents, right? Because all of the financing costs are going to fall on them. And I think a lot of reform is needed at FEMA. Colleagues and I did a whole series on this at Brookings a couple of years ago, but that's reform, not destruction. That means we need capable staff in the agency to be doing the good things that need to be done. And I mean, the headline this morning was actually that because this aid is so important for communities, it's actually not going to be clawed back as much as maybe was originally discussed. So we'll see.
Great, thanks. Don, go ahead.
I think there's this idea out there that risk is an individual burden, right? You have your insurance premium, that's for me, right? The only thing. But in actuality, risk is a community burden. You know, it's kind of saying that someone is always paying for that risk. If you might be being subsidized, you might be subsidized. And those grants that FEMA gives out are really good at improving community level risk. And in some sense, they do address premiums as well, because that risk reduction goes into the catastrophe models that estimate premiums. So I think it'll have a huge impact. We need more of those dollars. We need more community dollars to reduce our risk, because that's the only long-term solution to this insurance crisis.
Great, thanks. We had two questions here in the front row, and then maybe we'll stop in the middle, and then maybe we'll come over here if we can.
I wondered about, there's a special flood insurance program that people can buy. Should there be a special wildfire risk reduction program, a wildfire insurance program, a special national definition of wildfire?
Do you want to take?
You want me to take it?
Ben, you've been nominated.
I'm nominated to take this one. So I think, it's useful to remember why we have the National Flood Insurance Program, which is that the private market decided they weren't going to provide these policies anymore at a reasonable price. And so it was a necessity in response to a private market shift. I think we're seeing similar elements of that private market shift playing out right now. And at the moment, you can think of some of these state plans as stepping into that role. I think, the National Flood Insurance Program has had a variety of problems with it over its history. The way in which risk has been communicated has given people a false binary sense of, I'm in the flood zone, so I'm risky, or I'm outside the flood zone, so I'm safe. And the insurance has been massively underpriced for decades. So I think there's some important lessons that we can learn from the flood insurance program. I think in terms of the challenges that we face in terms of politically setting those premiums where they need to be, my opinion is that it's easier to impose standards at the secondary level of the market, at the reinsurance level of the market, and that let the insurers respond to it there. But I do think that there is some temptation in all of these things to push the risk away from those who bear it, and ultimately to underprice the risk. And so I think the key element will be to make sure that risk is priced appropriately. And whether these different state entities are going to take this role, and whether they take the role at the primary market level where they're interacting with households, or the secondary market level where they're interacting with insurers, that remains to be seen. But I do think one of the tools that we'll see develop in the coming years is a bigger role for public players in this space at state and federal levels.
Great, thanks. The next question was seated right next in the blue. But before we get to that question, we're talking a lot about homeowners, but of course there's insurance products for other types of entities. And I don't know if any of you have any thoughts about, like, for example, how we deal with the difficulties with insuring like utilities in certain parts of California. I don't know if you have any thoughts about that, or maybe any recommendations of organizations or individuals who are doing really interesting work on those topics. I know those are also hugely impactful, kind of to Dom's earlier point, right? These are community risks. And where we get our electricity from is generally a community thing or a regional thing. I don't know, Carolyn, if you have any thoughts about that.
Just a little bit about that. A lot more risk transfer options sort of open up when you're talking about large commercial or infrastructure scale. And so maybe there's a couple models that are helpful. One, you raise the utilities. California has struggled a lot with its utilities because they have a unique liability regime that makes utilities act like insurers and pay the full cost of any losses for a fire that's started by them, even if they're not at fault. It was, a tree fell on a wire and it sparked something and burns down houses. The utility is responsible. So so insurance was like, we're not insuring California utilities. They've created a state fund to support them. Elsewhere, other utilities are struggling with impacts from things like storms, and they have an industry captive. Captives are insurance companies that insure just the members. And so that's actually been used a lot. I think Ben has some other examples he could share when it's difficult to find coverage in the private market. But there's also different types of models that open up at that scale. One that I really like is FM Global. They've been around for a very, very long time. And they like to say that they're the only insurance company that hires engineers instead of actuaries. And they go out and do detailed risk assessments on every site. And those firms then implement those risk reduction measures, which then gives them low cost insurance. And so they've really integrated the risk reduction and the insurance together. The economics of that at a household level nobody's cracked the code on how to do it.
Okay, great, thanks. And go ahead, and then we'll move to the middle, and then we'll move to this side.
Hi, thank you. My name is Jose. I'm from New York, right from the house side. But my question is dealing with something that Carolyn brought up, but I had this question earlier in the presentations. So as private insurers leave areas of high risk, and we're seeing these high risk areas become more high risk, like you said, we're locked in to a lot of changes, Carolyn. And I was wondering, at what point do you think the federal government would step in? Or in general, how does government insurance look like for housing or any such thing? You mentioned a safe fund, so maybe something along those lines. Fairly broad question, so feel free to hit the points.
Okay, I'm making this too. So we already have a lot of government-created insurance programs. So the federal flood program's already been talked about. Every single state has a state-created program, a market of last resort for wind coverage or for wild coverage. Also, we're talking about climate, but earthquakes. So we already have a lot of that. And we also do it for other catastrophic risks like terrorism, right? And nuclear power. All of this has government-provided insurance in different ways. Who ultimately pays those costs varies dramatically across the programs. The NFIP costs sit with the federal government, right? The state programs have assessment authority, as I was saying, into the admitted carriers and the policyholders in a given state. Ben was referencing some programs globally that actually, the programs I just said that we have in existence today, write policies directly to households and businesses. But other countries take an approach like we do here for terrorism, which is to put the government as the backstop or the reinsurer. And so France and Spain, for example, require that all natural hazards be included in your property policy. But then if there was an event that was very severe, the government comes in, because the reason private carriers don't want to do that here is because insolvency risk. They will literally go insolvent if they have to carry all that risk. And so that's where the federal government, so there's like different ways you could design those programs. I don't know if that answered your question, if you had a different, if you wanted to weigh in.
Ben or Dom, if you have anything, please feel free.
Yeah, so I mean, when insurers leave states, it's generally because of a nexus of regulatory headwinds in terms of they can't raise premiums and the increasing climate costs. When those two really intersect, that's when you see insurers start to leave the states, like Florida and California. And so some of this could be alleviated through government programs where, as Bill was saying, they take on some of that risk. But also the idea that risk pooling is they're subsidizing insurance risk is a bad thing. It's not necessarily true. It's just a matter of where you put your value. And so I think that it's a matter of having hard conversations on how we want to have a market, have a system that takes on risk. Where do we want to place that risk, and how do we want to pay for it? So it's really it's a tough conversation because there's no easy answer, but that's really what we have to do to move the needle.
Great, thanks. And then we'll go to you, and we'll see if we have time for one more.
Hi, I'm Emily. And I'm curious, we talked a lot about like property and utilities, and I'm also curious how you would extrapolate the lessons that you're learning based off of the housing markets and private insurance, and how you translate that for lessons, for example, the risk management agencies in the USDA for crop insurance, or even going a step further, how would you think about that in regards to like fisheries disaster insurance? What would be a recommendation or a thought, or like how are you thinking about ways that we can actually improve these ideas without, it's such a challenging time right now because we're all talking about decarbonization, climate change, all these things we need to do, but we don't necessarily have the most friendly person who's leading us in this arena right now. So how would you speak to that?
Thanks for your question. I'll open it up to the panel.
That's good. One idea, especially when it comes to protecting revenues, and Carolyn spoke about this, is parametric insurance, where instead of protecting assets like indemnity coverage does, a good option is parametric, where it protects your balance sheets. So parametric isn't really good for traditional indemnity coverage because of something called basis risk. But I won't go into that. But the point I want to make is that some of those issues, when looking at more commercial aspects, you can tackle that with parametric insurance, where if there's a certain trigger, such as ocean temperatures for fisheries, that will give a payout to a collective members of the fishery organization. So there are these new tools that are coming out that could really make a dent in those different areas of risk that we haven't really touched before.
Ben, do you have any? Oh, Carolyn, please feel free.
I was just going to really quickly say, you mentioned the ag insurance program, and that's its own unique beast. And I'm definitely not an expert in it, but I have close colleagues who are and have been working with some participants in that market to create new insurance products that incentivize climate smart ag practices. So if it's an interest of yours, I'm happy to connect you.
Great, thanks. All right, I think we have time for one more. You have it. I saw your hand first. A usual briefing suspect.
It's kind of building on the question that Dan asked you a little bit about beyond the housing market. To what extent are these concerns germane for things, not just like utilities, but hospitals and airports and Carolyn, you already touched on sort of large commercial facilities, but what about the whole range of infrastructure? Does insurance issues impinge on the ability to build and rebuild key parts of infrastructure?
Thanks. Anyone? Ben, please go ahead.
I mean, the short answer is yes, absolutely. That all of these entities need insurance and are looking for solutions to this growing problem. I would say that the problems in the commercial space are actually quite a bit more acute than they are in the housing space. That the housing market has so many stakeholders and voters who are interested in supporting this market. And you have these state entities that have cropped up that are fairly robust in terms of making sure that you can have continuous coverage. And the limits on that coverage isn't that low. Whereas for commercial policy holders, the limit is far below the value of a big apartment building or some other large structure. And so you have a lot of the commercial market that's scrambling at the moment to try to find alternatives. One option is to create your own entity, to have your own insurance entity. I think we're seeing a lot of innovation in things like insurance-linked securities and cat bonds, where the market participants are bypassing the insurance market entirely and trying to place the risk directly in the capital markets. And so if you are managing a portfolio of hospitals, you say, well, I can either go to my insurance broker and they're going to go out and try to find me a quote, or I can take that risk and try to sell that risk in a more direct way to capital markets. And so I think we're seeing a lot of innovation in that regard. And I think that's where there's still some opportunities for more capital to come into the market to realize, oh, there's a set of products out there, a set of potential buyers for those policies, which are generally not very correlated with the rest of the macro economy. And so there's some opportunities there, I think, for risk hedging for some large players, and I think there's the potential for that. But in terms of the direct burdens that they're facing, I think that increases in premiums are even larger for those types of the hospitals. And you mentioned the airports. Airports are some of the most vulnerable entities anywhere because of where they've been situated, usually along water. So most of the country's airports are facing significant flood risk over the next 50 years.
You have the option of answering the question. You also have the option of just having the last word. If you'd like to go next, and then we'll give Carolyn an opportunity to weigh into either on the question or just something in general to leave our audience with.
Great, yeah. I'll answer the part of the question. And that's one of the topics that we haven't talked about yet is municipal bonds. And those are huge pieces of the financial system where many cities build infrastructure using muni bonds. And climate risk has not necessarily been priced in those yet. And at some point, for some cities, the option might run out for them to get municipal bonds. I'm thinking Miami, where at one point, there's going to be enough sea level rise that your infrastructure is going to be funded almost every week. And so is a financial institution going to lend money if they don't know if that city has the capacity to pay it back? And so it ties into the insurance question, but it's one piece of this puzzle that we have to talk more about.
Thanks. And Carolyn, if you have anything final word, you're welcome to take it.
I'll just quickly say what you heard from the senator and Ben and others. We really need to understand that this risk is a climate risk and that we need to be focused on lowering our emissions so that we don't get to even more catastrophic levels of risk that are truly uninsurable.
Great, thank you. All right, well, panelists, I think you all deserve a round of applause. That was a great presentation. That was really excellent. You all will start taking off. We have to be out of the room because there's another meeting at 2. There are some cookies left, I think. Also, no one drank Sprite today, so there's a bunch of Sprites over there if you're thirsty and you don't want any caffeine. I'd like to thank Senator Whitehouse for joining us earlier in our session. Thanks to his staff as well for help with the room and also helping us think of the idea for the briefing and brainstorming all of that. I have some really great colleagues that put a lot of work in today's briefing. So Dan O'Brien, who's not here today because he has jury duty, but Amory, Allison, Hannah, Anna, and Nicole, thanks for all your help. Nicole is here, Anna's there. Please feel free to check in with us if you have anything you'd like to say or ask us about. We also have great interns, Hadley and Whitney. Hadley is with us today, so thanks to all everything that you contributed as well. And our videographer in the back, Troy, thanks so much. Next up, we have, and there's our survey link. If you have 2 minutes and you haven't already taken the survey and you'd like to, we really appreciate that. I'll leave it there for 1 second. One Mississippi. Oops. Where are the? Oh, I thought there was another briefing slide. Anyway, we have some great briefings coming up. Next up in our next era of transportation and infrastructure series will be mass transit. That's on May 20th. We're going to be doing one on railroads that has a really good title called on May 28th. If you want to learn about rail policy. And then we'll be doing one on highways on June 13th. Subscribe to Climate Change Solutions to keep up with everything that we're up to and keep track of our programming. And Thursday, July 24th is the Congressional Renewable Energy and Energy Efficiency Expo. So if you like this, but you want 8 of them in a row, plus exhibits and a reception, then come to the Rayburn Foyer in the Gold Room on Thursday, July 24th at 9 a.m. We have a whole series of panels. We'll have members of Congress stopping by. And that'll be really great. On the House side, where our honorary co-host is Representative Emmanuel Cleaver. And on the Senate side, Senators Crapo, Reed, Collins, and Van Hollen are helping us with that. So hope everyone has a great rest of your day. It looks like it stopped raining. Thanks again for joining us and for seeing us through to the end of the briefing today. And thanks to our panelists. Have a good rest of your Tuesday.